For those of you who don't know what quad 4 means, let's just review. And again, thanks for everyone who's new watching this. But again, if you look to slide 5, Josephine, quad 4 is when you have, so again, the modeling premise is growth and inflation in rate of change terms. When neither growth nor inflation are accelerating, they're both slowing, you're in the fourth quadrant. That's a really bad place to be economically. So after that happens, once we get to the quad 4, so if we're in quad 4, this can be also called DEFCON 4 for that government. Because when you don't have inflation or growth in rate of change terms, you're in DEFCON 4. I promise you I did not prepare for this question. I didn't wear red underneath my shirt and color in red to tell you that the fourth quadrant is very bad. The reaction of governments, this is why we call it our government, our policy model, it really, when growth starts to slow, this quad 4 is part of what we call our GIP model. That's not G for government, that's G for growth, inflation, policy. So what happens to the P when you get a growth and inflation slowdown, when you have neither growth or inflation, when this thing starts to go down, these things start to go down, the policy reacts to taking whatever that currency is and knocks it down. We got to get dovish. Policy goes dovish. Okay? This is why emerging markets crash. Because in quad 4, both growth and inflation are slowing. The policy reaction is to devalue the currency. Then, guess what? Real consumption growth slows even faster because people have to pay 2 times for the same loaf of bread with the same currency. So growth goes down even faster, like really fast, and then you get a crash. Everything else crashes. That's the history of emerging market crashes. So Turkey, I mean, you're in a tough spot.
Yeah, no, you don't want to be long Turkey. Don't buy Turkey. All right,
and that's another reason to be long U.S. equities.
Yeah.
I mean, anyone who's long Turkish equities this morning we got plenty of hedge fund clients, institutional clients, long-only clients that have to make asset allocation decisions globally. We have RIA clients. We have individuals at home. If you just heard what I just said on Turkey, what are you going to do going into the holidays with your turkey? You're going to sell turkey. And then you're going to put it either in cash or you're going to put it into something else called another equity. That's called fund flow. So the turkey comes out and the NASDAQ or oil and gas stocks go in. Or you say, I'm not going to go there. They're too expensive. And you just put it on your mattress.
Yeah, totally.
One of the tweets I got from a Hedgeye hater this morning trying to play gotcha, another one of these guys with no names. How's that parabolic US dollar move going to validate your reflation thesis, buddy? That's what he said to me. I'm like, pardon? So he's asking, in rate of change terms, so when you look at a sine curve of inflation bottomed, what quarter was it last year?
Fourth quarter.
Q4 of 2015? Q4 20. Can you still see that down there, Carl? So inflation bottomed here. It's been moving up here. Okay? So that's called reflation. From here to here is called reflation. That should be green. Just for the sake of consistency. This should be green, all right? This has been a reflation. A strong dollar will be one of the many catalysts, but the biggest catalyst of all is lapping the Q4, Q1 period of the lows. So Q1 of 2017 should be the rate of change peak in inflation. Right here, this I should start to peak in rate of change terms. Rate as all the old wall publications that love to cite me every day and all of our great work, that's when they're going to all be saying inflation is back. Okay? After it's been going up for about 7 quarters. 6, 7 quarters. That's a long time in market speak. So the question from Gotcha Guy with no name, the answer is, and I said, hey, I'll answer the question on the macro show because that donkey's not going to be able to afford to pay for this. But the reality is that that's the answer. That, buddy, is where the reflation trade starts to run out of steam, and I'll be happy to sell oil and gas stocks, I hope, higher at that level. And maybe oil's around 58, 59, 60, and you could sell that too. But for now, it's still December. In a bullish trend, when something goes here, you sell some. Sell some. Something goes here, you buy some. When it goes here, you do nothing. If it goes and does nothing, and then it goes up here, then you sell some. If it goes here, does nothing, you don't do anything. It goes back down here, you buy some. Until the trend's broken. Really simple. That's called a bullish trend. This is why, with all of my liberal education and being able to go both ways like I do, we're one of the only firms that does go both ways, literally. Because in a bearish trend, this is the same damn thing. So the euro, what's interesting about it is that for a long time you couldn't break this kind of 105 level versus the dollar. Now it's broken. You're down here today at 103. So you cover some because you shorted it at 106, 107. That was the top end of the range. Now the top end of the range is 105. At 105 you short it again. Then it's going to go to 102. Then it's going to go 104. Then it's going to go to, like if it keeps going down, that's called breaking down. Lower highs and lower lows, okay? So that's a bearish trend. That's how I think about, I don't care if it's, again, trading cattle or the euro or Apple. It's the same process.
So one of the major roadblocks to sort of getting behind this iteration of the Abenomics trade was the fact that Japan was tracking in Quad 2 for Q4 here, and as well, and it's likely to be in Quad 2 for the first quarter of next year, and with so much pressure on international rates sort of spilling over into the JGB market, there was risk that they would actually start to tighten monetary policy on the margin.
Because that's what you should do in Quad 2 is you tighten.
You should tighten in Quad 2, not to mention that they would sort of fall behind the curve with respect to their recently adopted yield curve control framework. He signaled today that that's not going to be an issue. They're going to maintain that framework irrespective of what the data is doing, which if you look at Japanese data, it's very solidly in Quad 2. It should continue in the first quarter of next year as well. So now you've removed that potential policy roadblock. It's all systems go with respect to the yen and the Nikkei. So we'll flesh out those shots a little bit more.
Ignore these levels because that was euro. But if you just said, okay, this is the yen and change the numbers, same thing. Yen's in now a bearish trend in as much as the Nikkei is in a bullish trend. So when the Nikkei pulls back to the low end of the range, you buy the Nikkei. When the yen, again, sells off to the low end of the range, you cover yens. When it bounces to the top end of the range, you short the yen. Really simple. I mean, I think we're starting to really simplify it now. I got like 3 compliments inside of 90 seconds. That's new. Thank you.
I know you did this yesterday, and Ben has in the past, but he himself is a mucker. So could you walk through the significance?
He's a what?
He himself is a mucker.
A mucker?
A mucker.
Like a mucker?
Like a mucker.
Like with an M?
Yeah.
Like me?
Yeah, like you.
Yeah.
Can you walk through the significance of the difference between realized and implied volatility and what the math / difference reveals? Many thanks, and hope all is well.
Yeah, no problem. Oof. Let's see if I can do this as well as Ben Ryan. So you have this thing called time. And then let's say that time's 0, and then you got t plus 1 here, t plus 2. With t equals time. Realized volatility is everything that happened yesterday. So when we say on that table, Josephine, show that table quickly if you can. Realized volatility is the first column on the left side of the table. You can see that realized volatility on a 30, 60, and 90-day basis. So come back to me here, Josie. So we'll say that t minus 1, t minus 2, t minus 3 is minus 30 days, minus 60 days, minus 90 days. See that? When we say we're multi-duration, multi-factor, the multi-duration point is we're looking at everything we look at. It's not just volatility, obviously. We're looking at different buckets of time. This is 1 month, 2 month, 3 month realized volatility. Implied volatility is when, and you should look at apples to apples, or at least that's what I do. You can agree or disagree with how I think about that. That's an opinion. I think it's just steady Eddie, the way you should do it. But if I look at 30-day, if I look at front month implied volatility, that's again what the market is looking at volatility could be in the next 30 days. So that's When volatility is trading at a premium, so when we say a premium, implied volatility might be here, okay? So currently, S&P 500 implied volatility is like plus 26%. So again, versus the 30-day realized volatility, it's 26% higher. So people are, that's kind of steep. What ends up happening when everyone starts to say, oh my God, this market's never going to correct, is that this dot comes down, starts to flatten, and then the skew of what you call the skew of volatility starts to flatten out. Flattening skew means complacency. Again, when you get a steepening skew, that means that people are anxious. Think about it in real market terms. That's when everybody and their brother for the last 10 trading days or 14 trading days is like, oh, bro, this is overvalued. This is like totally like caped out, man. Like, it's like, look at the cape ratio. It's like, that's basically what it means. Okay, so for the last 2 weeks, every Tom, Dick, and valuation expert, Harry, has been out there shorting the market, again, expecting volatility to go up. And you know what's happened? Boom, pancake. That's what it means. Eventually, they'll just capitulate, give up, and the implied premium on volatility starts to come down. When it really comes down after a really big move, so something like energy right now, or even the NASDAQ. The NASDAQ currently, if you show that table again, Josephine, I think it's got like a minus 5% implied volatility discount. So if you look, you go back, volatility on the NASDAQ, unlike the S&P 500 on a 30-day basis, I think it's like closer to 13%. But implied is like at 12.3. Too many numbers here. But anyway, this is a discount. This is a premium. Discount, premium. Okay? So those are the three things that, even though I may not get tenure at Yale for that doodle, that's a little ugly. I gotta say, that's ugly. But for the very low price of what you paid to watch Macro Show today, I just explained. Realized volatility, three components in that table. Realized volatility, what happened yesterday. Implied volatility, what people are expecting. And then implied either trades at a premium or a discount. And that's where, again, we're trying to make good decisions because we like to fade the crowd. We like to do that. And that's one major component of fading the crowd, is seeing where options are priced. I know, I have at least a handful of clients who've sent me an email in the last 2 weeks. More of those came 2 weeks ago, by the way, when the market was going down. 3 weeks ago, really, that week of December, after the first week of December, a lot of people started saying, that's it, the Trump trade's over. And they got really, really hurt by that view if they put it on. And I don't, it just is what it is. I got run over after the Trump trade too. I just haven't been run over for the most recent 5-week period. But the reality is that people just get run over. But then they go back to all these emotional and visceral reactions. And one of them is, you know what, Keith? This market could just do 1987. It's just going to crash. I hear you, but there's really no reason behind that. And if Darius just gave you one saying that in Quad 2 we have crashed before, don't forget that he also said it happened in 2002. So 2002, for those of you who remember the history of the U.S. stock market, there's this year called 1999. In 1999-2000, the S&P 500, like 2000, let's just say it was somewhere around 1400. Economic cycle puts in its peak. By the time you got into 2001 and 2002, it was shallow, but you had a recession, okay? Economic growth was slowing and the market was already going down. By the time you got to, let's just put time and space here. By the time you got to 2002, you know where the S&P 500 was? 800, okay? You went from here to 800 on the S&P 500. It was like this. That was the last part of the move. Yeah. You don't crash. That's when you crash most typically. It's a lot harder to crash when you're making all-time highs every day than when you're making lower lows and lower highs in a bearish trend with growth slowing. Okay? Full process, full stop. So if you heard, wow, they just said Quad 2 we could crash because they did it in 2002. Again, go back to the process. The prevailing market conditions in 2002 were that growth was still slowing. It was starting to slow at a lesser rate. People who sold the lows in September of 2002 got killed. That's actually when I started buying stocks. That's the only reason why I made partner at Dawson in 2003 because I wasn't the idiot selling the low. Because again, the rate of change started slowing at a slower rate. You had a literal, from the peak of the 2000 level to the low of 2002 was a nasty bear market for stocks. Nasty. So that's predominantly why. And by the way, Quad 2 was a good investing period in the third quarter of 2002. And if you bought in Quad 2 in 2002, you killed it. I mean, you didn't even have to sell stocks till like 2007.